Imagine doing everything right. You call your insurance company, you report a problem, you follow their process exactly as you're supposed to, and then 2 years later, that same company turns around and tells you that you're uninsurable. Not because you committed fraud, not because you filed a dozen claims, not because you did anything wrong at all, but because you once tried to use the insurance you were paying for. That's the situation one homeowner found themselves in. And honestly, it should make every single one of us stop and think about how this industry actually works. Let's back up and set the scene here because the details really matter in this story. We're talking about someone who has been a homeowner for 10 years, a decade of paying premiums, maintaining their property, and never once filing a claim. That is the kind of customer every insurance company claims they want. Low risk, consistent, responsible. For 10 years, this person handed over their money faithfully, month after month, and asked for absolutely nothing in return. Then one day, a pipe leaks. Now, if you've ever dealt with a pipe leak, you know that the range of outcomes can be pretty wide. Sometimes it's a minor fix that costs a few $100s. Sometimes it turns into a full-blown water damage nightmare that costs tens of thousands. So this homeowner does what any reasonable, responsible person would do. They try to contact their local State Farm office. When they can't get through, they go online and submit a claim through the official website. Again, completely correct behavior. This is the system working as designed. State Farm calls them back, and here's where it gets interesting. The representative explains that the cost of the repair is actually less than the deductible, meaning if they process the claim, the insurance company wouldn't pay out a single dollar anyway. The rep essentially says, "You're better off just paying for this yourself." And the homeowner agrees. They pay out of pocket, the pipe gets fixed, life moves on. Fast forward 2 years. This same homeowner is now buying a new house. Exciting time, right? They call State Farm for a quote on a new homeowner's policy, expecting a straightforward conversation. Maybe they'd get a loyalty discount after a decade as a customer. Instead, they're told something that stops them completely cold. They are uninsurable. Not underpriced, not flagged for a higher premium, not put on a watch list. Uninsurable. And the reason given? That pipe leak claim from 2 years ago. The one where no money was paid out. The one where the company's own representative told them not to use the insurance. That claim, according to State Farm's system, is recorded as a loss. Let's sit with that word for a second. A loss. In insurance terminology, a loss is typically an event that results in the insurer paying out money. But here's the thing. No money was paid. Not 1 cent. The homeowner covered the entire cost themselves. Yet somehow, in the records that follow this person around the insurance industry, there sits an entry that says loss. And that entry is apparently enough to trigger a flag so serious that the company's own underwriting team has to get involved just to consider insuring them. The homeowner is understandably confused. They reach out online asking if this is normal. And the answer, frustratingly, is yes. This is actually completely normal. And that's exactly why we need to talk about it. Here's what's happening behind the scenes. Insurance companies don't just keep their own internal records. They also report to and pull from a shared database called the CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange. It's essentially a credit report, but for your insurance history. It goes back typically 5 to 7 years and records any claims you've filed, any incidents that were reported, and yes, even claims that were opened but never resulted in a payout. When this homeowner submitted that online claim, even though it was later closed without payment, an entry was likely created in the CLUE system. That entry doesn't necessarily say no money was paid. It may simply say a claim was filed. And to an underwriter looking at that file for the first time, that entry can look like a red flag. It can look like a property that has problems. It can look like a homeowner who files claims. Now here's the part that really gets under my skin. The homeowner did exactly what they were supposed to do. They used the official filing system. They listened to the company's own advice. They paid out of pocket to keep their claims record clean, and they still got penalized for it. This is a fundamental conflict of interest baked into the insurance system. Insurers have a financial incentive to track every single inquiry as a potential loss signal. even when no loss occurred. From their perspective, a customer who reaches out about damage, even minor damage, is statistically more likely to reach out again. So they flag it, even when their own representative is the one who encouraged the homeowner not to use the claim. There's also something else going on here that we should name directly. Insurance companies, State Farm included, are required in most states to offer coverage to homeowners who meet certain criteria. The word uninsurable gets thrown around a lot in these conversations, but what it usually means in practice is not that you literally cannot get insurance anywhere, but rather that you don't meet this particular company's current underwriting guidelines. There's a real difference between those two things, and it matters. In this specific case, State Farm told the homeowner that they'd need to reach out to underwriting to see if an exception could be made. That's actually a somewhat hopeful sign. It means the door isn't completely closed. It means a real human being might look at the full picture. 10 years of no payouts, one minor administrative claim that was never processed, and make a reasonable judgment. But the fact that it even has to come to that is frustrating, and it's worth understanding why. So what can you actually take away from this situation to protect yourself? Because if you have homeowners insurance and you're watching this could absolutely happen to you. First, before you ever submit a claim, call and speak to a human being. Don't use the online portal as your first step. Talk to your agent. Describe the situation verbally. Ask them to walk you through your options before anything gets entered into a system. A phone conversation that doesn't result in a formal claim filing typically won't create a clue entry. An online submission, even one that gets closed immediately, might. Second, know your deductible cold. If you have a $2,000 deductible and you're dealing with a $1,500 repair, you already know the answer. You pay out of pocket and you don't involve the insurance company at all. This isn't avoiding the system. This is using the system correctly. Insurance is for catastrophic or significant losses, not for routine maintenance costs. Third, request your own clue report. You are legally entitled to a free copy once per year through LexisNexis. Pull it, read it, know what's in there. If you see an entry for something that resulted in zero payout, you have the right to add a consumer statement explaining the circumstances. It doesn't remove the entry, but it adds context that an underwriter might consider. Fourth, if you're ever in a situation where you submitted a claim and then decided not to use it, follow up in writing to confirm the claim is closed with no payment. Ask for documentation. Create a paper trail. If this situation ever comes up again, you want to be able to hand someone a letter that says, on this date, this claim was closed without payment and without loss to the insurer. Fifth, understand that shopping around is not just acceptable, it's necessary. If State Farm says they need an exception, get quotes from other carriers at the same time. Different companies use clue data differently. Some weight it more heavily, some less. Some have more flexible underwriting criteria for long-term customers or customers with otherwise clean records. You are not obligated to wait around for one company to decide whether you're worthy of coverage. And finally, for anyone currently in this exact situation, here's a practical path forward. Contact your state's Department of Insurance. Every state has one, and their job is to help consumers navigate exactly these kinds of disputes. If you were denied coverage based on a clue entry that you believe is inaccurate or misleading, you can file a dispute directly with LexisNexis to have the entry reviewed. It's not a guaranteed fix, but it's a legitimate option that many people don't know they have. The bottom line here is that the insurance system, while necessary, is not designed with your interests as its first priority. It's designed to manage risk and minimize payout. That doesn't make it evil. It just means you need to understand how it actually works rather than how we assume it works. The homeowner in this story did nothing wrong. They were a model customer, and they still got caught in a technicality that most people don't even know exists until it's too late. If something like this has happened to you, if you've been denied coverage, flagged unfairly, or penalized for a claim that never even paid out, drop your experience in the comments. You are definitely not alone, and your story might help someone else avoid the same trap. And if you want to keep learning how to protect yourself when dealing with insurance companies, lenders, and anyone else who holds a little too much power over your financial life, make sure you subscribe. We break down these real situations so you know exactly what to do when it's your turn.